good afternoon, folks, and welcome to another educational video from Blue Sky Trading, where we strive to teach you everything that you need to know to be a successful trader. In today's video, we're going to be talking about trading strategies. We're going to go over why you need one, what the parts of a trading strategy are, and how to create a personalized strategy that's going to work for you to consistently make money over time. Look, if you can approach trading with this perspective in mind, you're going to be way ahead of probably 90% of other traders out there. Trading really is 1% buying, 1% selling, and 98% waiting. And what that means is, most traders think of trading as buying and selling. And really that's such a small component of what trading is. The majority of trading is doing your research, doing the analysis, and then most importantly, waiting patiently for that perfect entry. That perfect entry that has a high probability of working or a high probability of success. If you can master this, it'll prevent you from over trading, and it'll have a huge improvement in your profits over time. So why do you need a trading strategy? If you pull up any chart right now, pick whatever ticker you like to trade, most likely you're just going to see a bunch of random price movements. Stock prices move every day. Some days they're up, some days they're down. If you're trying to predict the movement of a stock, you really have no edge. In order to trade successfully or consistently, what you want to do is you only want to take those trades that have a really high probability of making money. If you're trying to predict moves, let's face it, you're just guessing on where the stock's going to go next. Whereas if you have a strategy that you can repeat with consistency over and over and over again, then you're not trying to predict movements anymore. Now what you're doing is you're reacting to a movement that you actually see in the chart, as opposed to trying to predict that movement before it happens. So how will you know which patterns are the best and when to enter the trade? Well, that's where your trading strategy comes in. Once you develop your strategy, it'll give you the set of rules that you need to only take those trades that have a high probability of making you money. A common mistake that retail traders make is they want to trade every pattern, right? They see all these YouTube videos, they read all these articles, they want to trade double bottoms, double tops, head and shoulder patterns, pullbacks, breakouts, and you can't be an expert on all of them. What you really want to do in order to have success in trading is you want to pick 1 to 3 strategies and really become an expert in it. You want to become so good at those strategies that you don't even really have to think about them anymore. That it's like mechanical. When you see it, you take the trade. And if you can do that, then you'll be able to consistently make money and avoid taking big losses. So what is this trading strategy? It's basically just a set of rules that you can apply to any chart to decide if you're going to enter the trade or not. Now, it needs to be detailed enough that it takes out any subjectivity. You want this trading strategy to be 100% objective. But at the same time, you want it simple enough that it's easy and quickly applied. You don't want something that's overly complicated that's going to take you too long to analyze, and by the time you finally realize, oh yeah, I should be in this, the stock's already moved too far and now it's too far extended. Basically, by having this strategy, you want to make trading as mechanical as possible. You want to take all the gray area out of trading. You want to take all the emotions out of trading. You want to make it mechanical, not emotional, every time you make a decision to get into or out of a trade. And finally, any trading strategy that you use needs to be back tested. And really, this is something you should do on your own. The main reason for doing it on your own is it'll give you the confidence to trust the strategy. It's easy to see, watch a video like this and somebody will show you a strategy. No strategy is going to work 100% of the time. So if you start using someone else's strategy, and let's say you have 2, 3, maybe even 4 times in a row where it doesn't work out, the 5th time you're going to be hesitant to take it. And maybe that's a time where it has a huge gain. Now, if you back test it on your own and really go through say hundreds or at least 100 historical examples of various charts, looking for that pattern, and come up with a number of what is the probability of success for that particular trade. And say you come up with, it's successful 70% of the time. Then even if you have those 2 or 3 unsuccessful trades, you'll still trust the strategy the next time it happens, so you won't miss out on a winning trade. So what are the components of a strategy? Well, there's three main parts. You need to define the conditions. Those are just the conditions that are required for you to even look at a stock, to even follow the chart. Next, you need to specify what is your entry or your trigger point. And that needs to be very specific. There's only certain times, even in uptrending stocks or even in stocks that are looking really good, there's only certain entries that are really ideal entries, and those are the ones you want to take. And finally, before you get into any position, you need to know when you're going to get out. You have to have an exit strategy before you even think about buying into a stock. If you don't know what your exit strategy is, then you shouldn't be buying it. All right, let's go over the conditions. So your trading strategy should specify a sufficient number of conditions to take out any ambiguity. This is what we talked about already. You want to take all the gray area out of trading. You want to use only primary indicators, never secondary indicators when you're looking at these conditions. So you want to look at things like price, moving averages, volume. I guess you can include Bollinger Bands as a primary indicator also. What you don't want to do is use secondary indicators. So those are things like the RSI, the MACD, money flow, any of those. I mean, those are great for determining market sentiment. They're great for looking at, what is the momentum of the stock? Which direction is it heading in short term? But you never want to use a secondary indicator as setting your conditions, or especially not as an entry point. You never want to use a secondary indicator to decide to buy a stock. So let's go through an example of a trading strategy. So this is one that I use. And again, if you're going to use something like this, that's fine. But make sure you back test it on your own so that you're comfortable with it. So I'll go through each of these conditions and kind of why I set up my trading strategy the way I do. So the first condition that I have is the price of the stock must be above the 200-day simple moving average. The main reason for this is I want to look at stocks that are moving up. It's extremely difficult, if you could even say impossible, to try and bottom pick a stock. The easiest money is made on stocks that are already uptrending. Again, this comes from basically you're reacting to what you see instead of trying to predict a bottom. So you see a stock's in an uptrend, you're reacting to that and taking a position. The second condition that I have is that the 21 EMA is above the 50-day SMA. So let me kind of step back here a little bit and just talk about some moving averages. What I like to do, and again, this is just the way I have my chart set up, for the short-term moving averages. So for me, that's the 8-day and the 21-day is what I use. For the short-term moving averages, I like to use the exponential. So the exponential moving average. The reason for that is I just find that it's more reactive, or gives you a quicker signal for those short-term time frames. On the longer-term moving averages, so for me that's the 50-day and the 200-day, there I like to use a simple moving average. And again, there's no real reason for this. Different traders will set up their moving averages in different ways. This is just what I found works for me. So again, you need to try what works for you. And sometimes I'll modify these. Like if there's a certain chart or a certain stock that I'm following, and I see that it continues to break one of these moving averages and then move back up above it, I'll try something different. I'll try changing the 21 exponential to a simple moving average and see if that lines up better with where the support and resistance levels are. So you need to be a little bit flexible on those. But anyway, that's how I have my chart set up. The third condition I look for is, so a stock that, like I said, it's in an uptrend, it's making higher highs, and then what I'm looking for is a pullback or a consolidation from one of those higher highs down to the moving averages, and that consolidation or pullback happens on decreasing volume. And the fourth item that I'm looking for, it's kind of related to the third one, but they don't always happen together at the same time, so that's why I have it listed as a separate condition. But I like to see tightening price action and a tightening of the Bollinger Bands. So let's go take a look at a chart, and we'll see how we can apply these examples in real life. All right, so here we're looking at a chart of International Seaways, ticker INSW. So let's go through each of those four conditions and see if this chart meets that, and if this is one that we should be looking at. So for the purpose of this exercise, we'll be looking at this area over here. So the first thing we want to look at is the price above the 200-day moving average? So the 200 on my chart is this green line down here. So we can easily see the price is above the 200-day moving average. So that condition is met. Second condition we want to look for is the 21 exponential moving average above the 50 simple moving average? So the 21 is my yellow line and the red is the 50. So again, we can see the 21 is indeed above the 50. So that second condition is met. The third condition, so we want to see a higher high, which we have right here, and then a pullback in the stock. And we want to see a gradual pullback down towards the moving averages. And we want to see that on decreasing volume. So we do have a pullback. It's a nice, gradual slope, gradual pullback to the moving averages. It pierced the 21, but never even got down to the 50. Starting to consolidate. So we can see that we do have this condition right here. And let's take a look at the volume. So the volume from this high right here down to here, let's say right to about there, we can see that we do in fact have decreasing volume. So we got a nice pullback on decreasing volume. So that condition is met also. And finally, the fourth condition, we want to see a tightening price action and tightening Bollinger Bands. So again, we can see, the price is staying underneath this slope line, so it is getting tighter that way. And we can probably draw, let's see, yep, that works too. We can draw a trend line this way. So we can see that the price action is tightening and the Bollinger Bands are getting a lot closer together. If we look from over here where this high happened, the Bollinger Bands here are almost 20% apart. And as they get tighter over here, they get to only 10% apart. So that fourth condition is met also. So basically by getting to this point, what we're saying is our conditions for our pattern have been met. And this is a stock that we definitely want to keep an eye on or watch. All right, so now we have a stock that we've confirmed it met our conditions. So what's the next step? Well, now we want to watch the stock and we want to wait for the right entry. Just because it's met the conditions doesn't mean it's a great time to buy it. We still don't know which way the stock is going to break. It could easily break down instead of up. So we want to wait for that correct signal before entering a position. So an entry criteria is basically a specific signal that indicates it's time to buy the stock. And again, here you want to use only primary indicators, never secondary indicators for an entry signal. So for the conditions that I use, this is what I like to set up as an entry criteria for myself. I like to see, or I want to see, a price break above a resistance line, but that breakout must happen on increasing volume. So if you remember, we were saying that the pullback we want to see happening on decreasing volume. So we want to make sure that condition is met. But then when we see the breakout, we want to see a pop in volume. So let's go back to that chart and take a look and see if there is an actual entry point for that ticker. All right, so we're back to INSW. So we've confirmed the conditions are there to follow the stock. Now we want to watch for an entry signal. So we have our downward sloping trend line. So what we're looking for now is we want to see a break above that trend line. Well, we can see that happens right here on October 12th. So we get a break above the trend line. And the nice thing about this break is that it held for the entire day, and the stock actually closed the day right at the high above the trend line. So excellent signal right there. So now let's go check our volume, because remember, that's our second part of the condition. So we look at the volume on this day, and unfortunately the volume did not increase. So we still have low volume continuing from this pullback. So in this case, I would not take this trade, at least not on this day, because it didn't meet both of my conditions. And that's a key point we should probably talk about here, is that you don't want to once you set up your trading strategy, you don't want to deviate. You don't want to look at this and say, well, you know what, it met part of my criteria, so let's go see what happens. You only want to take the trades that you know have a high probability. So when you see something like this that didn't fully meet your entry criteria, you don't want to take the trade. Now, you might say, well, look, if you took this trade, you would have been making money right now because the stock did move up. So it's a mistake not to trade it. Well, I argue that even though I didn't take the trade, I was correct not to take it, even though the price ended up going up. And the reason for that is it didn't meet my criteria. So this could have very easily reversed the next day. And then I would have been, down losing money and thinking, well, why did I get into this trade? I shouldn't have bought it. It didn't meet my criteria. What was I thinking? So you always want to make sure you stay, you follow your criteria, you follow your entry points, and you never deviate from those. And by doing that, you are going to miss trades. Okay, there's no denying that. Like this one, there are going to be trades that end up moving higher without you that you missed. But there's going to be even more trades that end up moving against you. So by not getting into it, you're saving yourself money over the long term. So you need to always look at it that way, that you're not going to catch every single trade. You're not going to catch every single stock that's moving up. So don't even try to. There's going to be lots of trades that you miss, but you want to make sure the ones you take are the ones with the highest probability. All right, let's look at one more example. So here we got a chart of Tesla, ticker TSLA. So for this example, we're going back to, I guess it's around the September-October timeframe of 2020. So let's use this as an example and try and test our conditions and entry point on this one and see how it works out. So let's start with the conditions first. We want to check to see, is the price above the 200-day moving average? So again, we can see throughout this entire time frame, the price is indeed above the 200-day moving average. So that first condition is met. Second condition, is the 21 EMA at or above the 50 EMA? So again, we can see the 21 is above and then consolidates to basically at the same level as the 50. So they're touching each other right through this area here. So that condition is met also. The third condition, we want to see, is there a pullback or a consolidation from the recent high down towards the moving averages? So again, we can see here was the recent high, and we have a nice consolidation. Let's see, we can draw it about like this. We have a nice consolidation, nice pullback. You can see it's above and below, so pretty much right at the moving averages and trending sideways. So that condition is met also. Oh, and actually we need to check one more thing on that one. We need to make sure it's happening on decreasing volume. So we look at the volume up over here, and we can see, in fact, the volume is decreasing at a nice gradual rate during this pullback and consolidation. So that third condition is met. And then the fourth condition, we want to see tightening price action and tightening Bollinger Bands. And again, we can see if we draw a trend line down through here, we can see that the price action is staying within these two bands and is definitely tightening, and the Bollinger Bands are also tightening. Again, we can look at back over here at the high, the Bollinger Bands were, almost 100% apart, whereas down over here, they've gotten to within about 10% of each other. So a nice tightening action over this time frame, over that 2-3 month period. So we have all the conditions met in order to watch the stock. So the next part now is there an entry point? So we want to look for a break above the trend line on higher than average volume. So we're watching the stock trend sideways, and here it is. So the stock price breaks above, ends up pulling back slightly, but still closing the day above the moving average, above the downward sloping trend line. So we do have the breakout, and now we want to check the volume. So we can see on that day, we had a huge spike in volume. So this day would meet our entry criteria. Now, another way you could look at this, and so this is what I like to use. I like to use the downward sloping trend lines. What you could do instead is you could define your resistance line something like this. So if you don't want to use that peak, you can see that as this price action was tightening, there was very clear resistance at this level. So the stock price came up to this, right around 155 level. It did it 1, 2, almost there, 3, 4, 5, 6, 7. Several times it comes right up to that level and ends up pulling back. And even on this day here, where I most likely would have taken an entry because it did break the downward sloping trend line, you can see it came right up to it and pulled back. So if you didn't want to take the trade on that day, that's fine. You can continue to watch the stock. You would have seen that the next day it breaks above that trend line, and again it does it on even higher volume. So this would definitely be a clear signal to get into this stock. And you can see if we're doing this as a back testing exercise, you can see if you would have gotten in on either of those 2 days, you would have made some really nice profits. So even if you got in, say, at the top of this day here, right there, from there to the peak, you're looking at about an 80% gain in only 35 trading days. So really nice move off of this stock. All right, so we went over a couple stocks. We saw one where the conditions were met, but it didn't really meet our entry criteria, so we didn't take the trade. And then we looked at another stock, Tesla, where not only did it meet all of the conditions, but it also met the entry condition. And we saw that if you would have taken that trade, it would have resulted in some really nice profits. So now we get to the final part of a trading strategy. Remember I mentioned before you ever get into a stock, you always want to know where you're going to get out. You never want to buy it if you don't have a plan for getting out. So the exit strategy really has two parts. You need to know what is your exit on a profitable trade, and what is your plan if the stock moves against you. So first, let's look at the losing trade. Like I mentioned before, even if you have these trading strategies, they're not going to be correct 100% of the time. I don't know a single strategy that is. So you need to know roughly what your probability of success is with the strategy that you're using. And then you need to know where to set your stop, or in other words, where is the, oh, I'm wrong location on the chart. And again, your stop has to be based on the chart, not based on, I don't want to lose more than X number of dollars. That's a whole separate topic that we're going to cover actually in another video on risk management. But for the purpose of a stop, it must be at a point that makes sense based on the chart. You never want to move your stops down. Once you set your stop, and say the stock starts moving against you, one of the worst things you can do is say, well, you know what, I probably put my stop in the wrong place. I'm going to move it down a little and give it some more room. That's usually doing that results in bigger losses. Once you enter a trade and you have your exit plan in place, you don't want to modify it. And the third point is never add to a losing trade. There's a common saying, I guess, between professional traders or Wall Street traders, and that saying is only losers add to a losing position. If a stock is moving against you, it's obviously not doing what you thought it was going to do, especially in a case like this. The examples that we've been going through are breakouts. If you're buying a breakout, that means you're expecting the stock to continue moving up. If it doesn't, and if it starts to reverse, well, it's doing something that you didn't expect it to do. So why would you add to the position? It no longer meets your criteria for moving up because now it started to pull back. So never add to a losing trade, never move your stops down. Those are there to protect you and to protect your account balance. So now let's talk about a profitable trade. So what if you do get into a trade and it starts moving up? Well, you need to have a plan on how are you going to lock in profits? At what point are you going to start selling? How are you going to move up your stops? Are you going to use trailing stops? Are you going to move up your stop all into one location? You need to have a plan on what you're going to do. There's two reasons for that. You never want to let a profitable trade turn into a losing trade. It's terrible for your emotional health of trading. It'll mess with your psychology. It'll mess with your mind. It'll mess with your confidence, and you'll be more hesitant to take a trade in the future using your strategy. So you never want to let a profitable trade turn into a losing trade. So you need to have a plan on how you're going to prevent that from happening. The other part of that is, though, you don't want to get out of a trade too early. If you say you're profitable and you're up, 5%, 7%, and you sell, and then a stock like Tesla, the example that we just looked at, it ends up moving up another, 80%, you missed out on all that profit. So you never want to leave, that much money on the table. So your exit strategy must take both of those into account. And we'll see how that works here in this example. So for that, let's go back to Tesla. All right, so here we are back at the Tesla chart, looking at that entry that we looked at here a couple minutes ago. So let's say we took the entry on this day right here. So we're in Tesla. let's say let's say even if we bought towards the high of the day. So we're in around $162 as our entry. So let's go over the exit strategy for a losing trade first. So when you enter this trade, what you're saying is that the stock broke out and you're expecting it to continue to moving up. Ideally, you're expecting it to stay above this 21 EMA now that it broke out. So what I do for an example like this is I'll put my stop right below these moving averages, and it almost always lines up with the midpoint of this range. So when you look at the range from, I guess that'll be about 156 down to about 109, let's say 110, roughly the middle of that range is where you never want to see the stock drop below after a breakout. If it does, that means it was a fake breakout or a false breakout. So on an entry of 162, I would put my stop, right around here somewhere, let's say around 138, 139. So it's about a 13% risk is what you're taking on this trade. So if the stock were to pull back to there, you'd get stopped out, and that would be the end of this trade. Now, in this case, the stock ended up moving in our favor. So how do you decide on when to lock in profits, when to sell, when to get out of the position? So the way I do that, and again, you got to find what works for you, because different traders will do this differently. There's two ways you can do this. One is you can start to sell partial positions or lock in partial profits when it hits certain targets. The other way to do this is to create what's called staggered stops and place those stops so that even if the stock were to move back, you would still lock in some profit. So let's look at both of those examples. So if you got in here around 162 and the stock starts to move up, so you can see it's moving up fairly steep, and it's staying above the 8 EMA. So the 8 EMA is this purple line right here. What you could do is, after this initial run here, say you're around here, you're up about 33%. Actually, even here, in a very short period of time, in only 8 trading days, you're up about 25%. So really, there would be nothing wrong with, say, locking in, maybe selling 1/4 of your position at this point, or even maybe 1/3 of your position, and lock in that 24% gain. If you were to do that, then what you should also do is this stop that you initially set down here around 138 or 139, you should now move that up to break even. So your entry point of 162. So effectively what you've done is you've locked in a 25% profit on, let's say, 1/3 of your position, and you put your stop at break even on the rest. So absolute worst case scenario, let's say this stock, some kind of news comes out or something happens and this stock just plummets. The worst case scenario that you can get at this point is that you'll make 25% on 1/3 of your initial position. That's not bad. You're still making money, right? But you don't want to sell everything there because you want to let the stock work if it's still working. So then you see the stock continues to move up and is still trading mostly above the 8, but always above the 21. So at some point again, maybe on a day like this where you see a nice big move up, you'd want to lock in some more profits. So you need to have a strategy that works for you and that you can consistently follow. The other way to do this, instead of taking partial profits, is to move up your stops instead. So the way that would work is your initial stop is down here at around 139. As the stock moves up from your entry point, say, around this level here, where you're up now 25%, instead of selling a partial position, what you could do is you could set a stop right below this 8 EMA for, let's say again, maybe 1/3 of your position. So you have a full stop for your entire balance here at 139. You now change that so that 1/3 of it would get stopped out below the 8 EMA. And you could I'd probably put the other 2/3 at break even. So you can see you don't get stopped out and the stock continues to run higher. So in this case, this actually would have worked out better than taking the partial profits here. But, again, you could look at another chart and it would be the opposite. So the stock continues to run up. And as it does that, you continue moving this stop up to stay just below the 8 EMA. And you would see either on this day here, you might have got stopped out, or definitely on this day here, you would have got stopped out of 1/3 of your position. That's still not bad, because that would still give you a profit of 22% on 1/3 of your position. Now remember, your other stop, your remaining 2/3, is still here at break even. So now at some point, you're going to want to start moving that up also. So you've been stopped out of 1/3, and now the stock continues to run higher. You might want to break up that 2/3, that remaining 2/3, in half again. So again, put 1/3 of your stop. Maybe now you want to use the 21 EMA, so somewhere like around here. And again, as the stock continues to move up, you want to continue moving your stop higher and higher to lock in more profits. Obviously, another thing you can look at is, the stock's moving up at a really nice slope over here, and then all of a sudden it starts to really get parabolic. And that's usually a sign of a pullback coming. So when you see something like that, you definitely want to make sure you're moving your stops up quite a bit. Or on a day like this, or especially on a pullback after a day like this, I would definitely be looking at taking some partial profits. So those are a few examples of how you can do that. But again, it's got to be something a strategy that you do consistently. Pick one or the other. Don't go back and forth between the different options we discussed. Pick one that you prefer and just stick with it. And stick with it on every single trade that you do. So that pretty much covers everything we wanted to go over in this video. So again, to recap, we went over what a trading strategy is, why you need a trading strategy, and hopefully now you have a better understanding of how to set one up and how to personalize one to work for you. And again, remember, the whole point of having the trading strategy is really to take the emotions out of trading, to have a concise, consistent set of rules that you can follow repeatedly, and basically to know exactly when to get into and out of a trade. So that's all we got for this video. If you enjoyed this content, please hit the like and subscribe buttons. And please check out our other videos. We do have some other videos, some really good topics. We will have one on risk management that you definitely don't want to miss out on. And we're also doing one on the psychology of trading, which will be a very informative video also. So please be on the lookout for those. And once again, thanks for being with us, and we'll see you next time.